So, what are the biggest decisions that still face executives in modern businesses? Watch this video to enhance your understanding.
A company typically has multiple options for expansion, but limited capital. How does an executive decide exactly which real asset to purchase? The decision relies on the time value of money. A dollar held today is worth more than a dollar received tomorrow, because the dollar today can be immediately invested to yield a return. If a firm has $1 million in cash, it could invest it in a new physical product line, or it could keep it in a high-yield savings account. The potential profit the firm loses by not choosing the next best alternative is defined as the opportunity cost of capital. Executives must mathematically weigh this opportunity cost against the future inflows they expect a new factory to generate. This timeline chart illustrates a metric called net present value, or NPV. NPV is the primary mathematical tool used to compare the value of all projected future returns from a project against the initial cost of the investment today. NPV acts as a strict pass-fail test. If the final calculation is positive, the project creates shareholder value and should be approved. If it is negative, the project destroys value and must be rejected. This calculation is the definitive financial filter. It prevents executives from deploying capital into projects that might look physically impressive, but would ultimately drain the company's resources. Formulas like net present value assume that the numbers fed into the equation are accurate and that the market operates efficiently. The reality of the global economy is far less pristine. Markets are riddled with friction and deliberate deception. Corporate fraud, including false invoicing and hidden debt, costs the global economy over $5 trillion every single year. An elegant mathematical model is completely useless if the data regarding the real asset is compromised. Calculating future inflows based on false reporting guarantees a massive loss of capital. To counter this, executives rely on due diligence. This is the rigorous investigative process of verifying asset values, auditing financials, and uncovering hidden liabilities before a single dollar is committed. Even with flawless due diligence, a single firm cannot isolate itself from the broader global system. External forces can instantly rewrite a company's financial calculus. We define these external forces as macroeconomic shocks. Sudden global events like rapid inflation, geopolitical friction, or a pandemic can instantly sever supply chains and drive borrowing costs vertical,